Hello, welcome back. So, Alphabet or Google is one of the companies that I really wanted to add to my portfolio. Yet it was always relatively expensive. So, if you take a look at the 1 year chart, for example, you will see that the company stock price was near 3,000 for the most part and actually surpassed 3,000 1 year ago. And I couldn't buy back then, it was expensive. So I was waiting for the opportunity, and as you will see, Google has given us a good opportunity to buy and has grown through the quarters and the years pretty much. And if you take a look at the stock news, the stock is being discussed a lot about a lot of different things. The fact that it is trending. This is an article that I found very interesting. This is Google stocks decade, and I have it opened up here, and I really agree with this article, and I wanted to kind of mention it because some investors may be overly concerned about the new dot-com era, but this is not the same thing, not even close to what was happening back in the dot-com bubble. These companies are right now pretty cheap actually compared to what they are and compared to their industry and how they are doing financially. Because Google is, of course, well positioned to weather even the worst recession, of course, yeah, with a huge balance sheet in terms of FCF, free cash flow. And you have heard me talk about this in my channel a lot. If you're anticipating a recession or a period where things are gonna be down in terms of how companies are growing and what they are doing financially, it's a very good idea to own companies that have great free cash flow, great balance sheets, little debt. They are making tons of money. That's what you want to be holding, not the companies that are net income negative or they're actually holding a lot of debt. This is what you don't want. And so the company has never traded at such a low PE ratio, and that's a low PE ratio based on the industry and what the company is doing in terms of its growth and everything. And of course, the article is going to be talking a lot about all sorts of different things about Google and compare it to companies like Apple. The fact that it is a growth machine has been growing tremendously well. That's not the point. We don't really examine the article here, but I just wanted to mention it because some of the key things that were mentioned in this article is things that I totally agree about, and we can kind of see those things when we take a look at the key metrics of the company in the financials. Now you will see the P ratio is 20 and price to free cash flow ratio 22. Slightly more than what we would like for our threshold, but of course that doesn't mean that it is not a buy, because it's a different thing to buy a company on a 20 PE ratio, for example, if it is an industrials company, but it's a different thing to buy a major tech industry at a 20 multiple, because there are different growth rates among different other things like margins, for example, which are awesome for a company like Google, or return on equity, which is also awesome. And take a look at this revenue growth for even for a behemoth here like Google. This keeps increasing tremendously, and this is actually even last year where there was tremendous increase in what the company is doing in terms of revenue. Same thing with net income and free cash flow and total equity. So the company is increasing everything here, doing financially awesome. And again, it's a company that is a high grower, great margins, great returns. So well, there's nothing to not like. And if you take a look at the income statement, for example, you will see the massive growth over the years, more than doubling their revenues since 2017, and more than like six times its net income of 2017 is what they actually did last year. So this is absolutely insane. They are explosive in terms of the net income growth that they're having. 88% over here from last year, absolutely insane. And if you take a look at their balance sheet, you will see that it is also increasing tremendously, 152 billion to 251 here. You will see that the retained earnings have grown from 113 billion to 191. That is the net income accumulated in a permanent account, which is the retained earnings account. And the cash flow statement, another great thing to see. Operating cash flow that keeps increasing, like tripling almost since 2017. And yeah, the company is investing a little bit. For the most part, you will see that it is capital expenditures. And also, the company is also financing, actually paying back in terms of financing activities here. It's paying back debt, for instance, here, and of course, repurchasing common stock like mad maniacs. And they're going to be repurchasing much more. They have announced that. There's also a stock split that's going to happen. And this typically tends to drive the price upwards for no real reason, frankly speaking, but people like lower prices, and the split will do that. So people tend to flock in and actually buy more stock when that happens. It's a psychological thing that tends to bring prices up, at least for a period of time. And the cash that they have, 21 billion, and the free cash flow from 24 billion to 67 billion. A free cash flow machine and a net income machine, a machine generally speaking, that doesn't even require to be oiled up. It's working awesome. And let's take a look at the stock evaluation tool, because we want to see whether this is a bargain for buying Google right now, if it's a good price. And it's very, very tough to find these awesome companies at green prices here, at green projections. And when that happens, I want a piece of them, especially companies like Apple, Facebook, Google. Amazing free cash flow generator companies, pretty much. And so companies of this sort, Microsoft is another one. These kinds of companies I really, really want to own at a fair price, though. And again, whenever I see green with logical projections, I'm definitely buying. So the company has been doing tremendous in terms of revenue growth. We will start our projections here with 12%, which is the lower of the 5 years. Their average has been 23.6 here, 23.7 is what they have been doing in the last 5 years. Of course, we're going lower, but I'm gonna go 12, 15, and 18, which I think is very achievable actually. And again, the 5-year average has been 23.69, and 18 is actually their second worst year here. So I think that's very fair. Of course, you can try lower estimates if you like. And the net income margins over here, typically it's about sometimes 21, 22. Last year it was 29. So I'm going to go with the lower one here, 21, 23, and let's say 25. And the free cash flow margin, I'm going to go with something typical, 80, 90, and 100, which is somewhere in between the last few years. And the annual return of 13% over here. And we hit calculate, and we see that for these kinds of estimates that we have here, it's our high one that is green, yet our medium one is also pretty close here. And remember that we use the revenue growth of 15%. If we go a little bit more, I guess, aggressive, then you will definitely see this one also becoming green here. So for example, if you go with your medium ones here as 18%, you are already green. And 21 could be our high ones, and then you get greens all over the place here. Now, of course, you may want to be a little bit more conservative, and you go maybe with 12 or 13. So if you go that low, 12, 13, and 14, in this case, you will be marginally off here, actually substantially off for the medium, but you are still green for the high, and the high is just 14% revenue growth and a net income margin of 25%. And remember, the stock has actually been lower. It keeps going a little bit higher these days, so you did have the opportunity to buy at an even lower price than it is right now. But still, even at this current price, remember that you are not buying a company like Target or Walmart or an industrials company. This is not the same thing. It's a good idea to pay a little bit of an extra multiple for buying this kind of company, which has some merits, some extremely important merits. The fact that it's buying back tons of shares, their margins are high, they are a free cash flow machine, a net income machine. They are doing fantastically well in financials. Their return on equity is awesome. They don't have debt. I mean, all these things matter and allow us to buy at higher valuations. We don't want to overdo it, of course, but we are not overdoing it. We are still conservative here. These numbers are conservative based on what the company has been doing. If you take a look at this one, even an average of like 20% would make a ton of sense. And so you could potentially even go something like 16, 18, and 20 here and still be fine, still make sense, a ton of sense really. And if you do that, then you get greens for medium and highs. And also the net income margins that we use are suppressed here as well. We started with 21, 23, and 25, and the company last year did 29. So they could potentially continue achieving this kind of margin. And if they do, for example, then you're going to be getting better results here. So of course you can adjust and see what happens. But I think these kinds of estimates that I'm having over here make a ton of sense. And yeah, even the medium ones would be green here. It is where we are. And yeah, again, this actually was lower at some point. So yeah, Google for me right now is definitely a buy. don't be confused from the fact that the low estimates are red here. Doesn't make much of a difference really. Again, it's important to know what you are buying and what kind of potential the company has. And it's a different comparison to compare a red result, for example, on a company like Target, and much different to have a red result on a company like Google. Very different situation, completely different industries. This matters a lot. And so when you get the opportunity to buy Google at this kind of valuation, I myself am definitely a buyer. And this way I bought, actually. I have bought Google so about a month ago or so. And frankly, I could definitely see myself buying even more. I think this one is a massive opportunity here. And along with my other investment in Facebook, I think these ones are primed for a breakout at some point when we go to normal, to our market normal, really. I really like these businesses here. Yeah, this one is definitely a good opportunity to accumulate a little bit, and I'm having trouble thinking that we're gonna be getting much lower prices for a company of this sort. We'll see though. You never know at this current market. Maybe we can even get Google at a lower price. Who knows? So thank you for watching this video. I hope you enjoyed. Remember to leave a like and subscribe, and I'll see you in the next one, guys. Bye bye.